Is Northrop Grumman stock, ticker symbol NOC, a possible buy now? We're using the Select 6 analysis to look at the most telling financial metrics before estimating a fair value for Northrop Grumman. You'll want to stick around till the end when we give our rating. This analysis is going to be intense but worth it. Along the way, there's going to be a key bonus metric that just might be the tipping point when analyzing Northrop Grumman for your stock portfolio. Before we get into these valuable metrics, how has Northrop Grumman stock performed? Right now, the company trades for $440.19 per share. Year to date, their stock price is down 24%. This is way underperforming the S&P 500, which is up 12%. In the last decade, it's a totally different story for Northrop Grumman. They're beating the market handedly, compounding at 16% annually over this time. Going back before the global financial crisis, in the last 18 and a half years, Northrop Grumman has compounded at 12% annually. They traded in line with the market up until around 2013. Since then, as mentioned, they're significantly beating the market. Northrop Grumman trades just $23 above their 52-week low. The company's down more than $116 from their 52-week high. Still, just 1% of their shares are sold short. Northrop Grumman is a big business. They have a $67 billion market cap. But the burning question is, why should we be paying close attention to Northrop Grumman? Northrop Grumman is a diversified defense contractor providing aeronautics, defense, mission, and space systems. The company's aerospace segment creates the fuselage for the massive F-35 program and produces autonomous and piloted aircraft such as Global Hawk drones and the new B-21 bomber. Defense Systems makes artillery and missile ammunition and guidance systems, missile defense systems, and conducts maintenance and upgrades on numerous military aircraft. Mission Systems creates and integrates a variety of radar navigation and communication systems for avionics, weapons control, and countermeasures on a range of platforms from helicopters to destroyers. Finally, Space Systems produces satellites, sensors, space structures, and manufactures long-range missiles and rocket motors. With that overview of the business, now let's dive deep into their numbers. Starting with metric number 1, we want their average return on capital in the last 5 years to be above 14%. A typical business earns a 7% return on capital. By looking for a benchmark that's double this, we can build in margin of safety based on the quality of the business. Northrop Grumman has earned returns in the low to mid double digits. They boosted returns in their last 5 fiscal years. With their returns up, especially since 2020, they earned 21% returns in their most recent fiscal year. When their returns are averaged out, they're earning 18.8% average returns in a given year. That's a handful of percentage points above the 14% benchmark we look for. This is a strong check on metric number 1 for Northrop Grumman. Metric number 2, we want to see growth in the business. We're looking for revenue, net income, and free cash flow growth in the last 5 years. This metric's all or nothing. All 3 need to be up. We'll also include their numbers up until today. In this time, Northrop Grumman has grown their revenues 26%. Their net incomes or their earnings have grown by 44%. However, the company's free cash flows are down 12% overall. Digging deeper into this, the big hit to the business came from a charge in their other operating activities, which saw back-to-back years with almost $3 billion in expenses. You'd want to dig into the company's filings to understand those charges in more depth. Because of this, their free cash flows are down, which means this is an X on metric number 2. Metric number 3, we want to see earnings per share growth. This looks at Northrop Grumman from the view of an individual shareholder. We learned their net incomes or their earnings have grown by 44% in our last metric. At the same time, Northrop Grumman has bought back 12% of their shares outstanding. They've repurchased an eighth of their business, which increases the ownership percentage for existing shareholders in the business without them having to spend a dime. It's almost as if Northrop Grumman's making a partial acquisition of itself. Like any other acquisition, we want them to be getting more value than the price they're paying. That depends on what the overall valuation for the company is. Thankfully, we're using 2 different methods to estimate that later in our analysis. Still, with higher earnings and fewer shares outstanding, they've grown their earnings per share. This is a check on metric number 3. Metric number 4, we want to see free cash flow per share growth. Northrop Grumman's free cash flows are down over this time. Even though they bought back 12% of their shares, their free cash flows are just very slightly down. In their last 12 months, they produced $14.77 worth of free cash flow, just 7 cents below where they were at in 2018, but still down. On metric number 4, this is an X. To recap so far through 4 metrics, Northrop Grumman is split evenly. They have 2 checks and 2 X's. Before we continue on with our analysis, let's check on our bonus. Right now, Northrop Grumman pays a 1.64% dividend yield. We want their dividends to be supported by their free cash flows as our bonus. Northrop Grumman has grown their dividends in each of the last 5 years. At the same time, we learned their free cash flows are down. Still, even though their free cash flows are down, they produce enough free cash flow to be able to support their dividends. While they have increased their dividend payout ratio, these are still supported today. They've been supported in their last 5 years as well. This is what we're looking for. It's a check on our bonus. In recessions, it's businesses with lots of debt that can have the biggest losses or even go bankrupt. Metric number 5, we want their net debt, which is their total debt minus their cash and their short-term investments, to be below the sum of their free cash flows in their last 5 fiscal years. Northrop Grumman ended last year with $12 billion in net debt. Today, they've increased this. They have $13.7 billion of net debt. In their last 5 fiscal years, Northrop Grumman has produced $12.1 billion of free cash flow. That's coming in $1.5 billion below their current net debt position. They would have supported where they were at in 2022. However, that's not the case today. Because of this is just slightly off, but it's an X on metric number 5. They produced $2.26 billion of free cash flow in their last 12 months. Unfortunately, even when we project that out over the next 5 years, if their free cash flows are the same, that's not enough to support their debt position. It's something you'd want to dig into and learn a little bit more about to understand if their debts could potentially get the business into any trouble. There are reasons as a defense contractor why this higher debt load might be okay for the company. Still, it's likely worth your time to dig in and learn more. The big metric of them all, metric number 6, we want their average 5-year free cash flow divided by their enterprise value to give us a yield that's above 5%. If this is the case, this gives a slight risk premium to the yield of the 10-year treasury. It's the first of 2 different ways we'll estimate a fair value for the business. Right now, they have an $80 billion enterprise value. This accounts for both their market cap and their net debt position. It looks at Northrop Grumman similar to it being a private company. We learned in their last 5 years, they produced $12.1 billion of free cash flow. This means they produced $2.4 billion in an average year. When we divide that by their $80 billion enterprise value, we get a 3% average free cash flow to enterprise value yield. On a current basis, Northrop Grumman produced $2.26 billion of free cash flow in their last 12 months. When we divide that by their enterprise value, we get just under a 2.9% current free cash flow to enterprise value yield. These are both down from the yield of the 10-year treasury. They're below our risk premium as well. This means on metric number 6, it's an X for Northrop Grumman. Don't just throw the business out. We're not finished. We still need to estimate their fair value per share and talk about our rating. Everything we've discussed so far is important, but there's something missing that in my opinion is the main reason to analyze Northrop Grumman. This takes us on to using a discounted cash flow model to estimate their fair value per share. A DCF model is based on the predictability of a company's free cash flows. Like any model in any discipline, its outputs are sensitive to its inputs. We'll start with their current free cash flows and use historical assumptions to grow these into the future. Northrop Grumman has been extremely predictable in their past. This is because as a defense contractor, much of their business operates on long-dated contracts. If we assume they grow their free cash flows at 7% annually in the next 10 years, then in the following decade, we'll assume this growth rate declines to growing at 4% annually. We won't add in their tangible book value as that's skewed based on how the accounting is done for their share buybacks. Northrop Grumman has bought back a lot of shares since 2003. If we want a 15% rate of return, which is what Warren Buffett looks for from his investments, if their valuation multiples look to be the same 20 years into the future as they are today, an estimate of Northrop Grumman's fair value per share is around $143. That's down nearly $300 from their current stock price. Keep some key points in mind. Northrop Grumman is a very large and very established, stable business. Defense contracting is normally thought of as a defensive industry. It's less likely for a company like this to have significant mispricings in their stock, especially when you're trying to get outsized returns like 15% annually. That would be crushing the S&P 500 over the long run. Keep in mind, not adding in their book value because of how that's skewed also plays a big factor in this valuation. This is why it's an estimate for the company and it's up to you to dig in and learn more. Most importantly, this analysis is not financial advice. It's not a buy or sell recommendation of any security. Consult with your financial advisor before you make any investment decision. In just a minute, we'll talk about our rating for Northrop Grumman, but we need to address something first. We've covered the numbers, but the qualitative factors may be even more important for their business. What are they? We'll start with a long thesis. Number 1, Northrop Grumman has won the Ground-Based Strategic Deterrent and B-21 bomber programs, both of which should drive material top-line growth over the next few decades. Number 2, Northrop Grumman's space segment is the dominant provider of rocket motors. due to its 2019 acquisition of Orbital ATK. Number 3, defense contractors' business cycle is not correlated to GDP. This potentially makes it more recession-proof than other industries. But we'd be remiss if we didn't cover the negatives of their business as well. Let's look at a short thesis. Number 1, Northrop Grumman depends on US military funding for its sales, which is an inherently political and thus uncertain process. Number 2, there's a risk that upstarts like SpaceX will threaten incumbents' oligopoly in space contracts, such as space transportation programs and satellites. Number 3, Northrop Grumman has a relatively high proportion of classified work, which limits visibility into the business. Those are some of the business's qualitative factors. Now let's talk about our rating. We've learned through analyzing Northrop Grumman, stock ticker NOC, the company goes 2 for 6 on our Select 6 analysis. They also check our bonus. They've earned high returns on capital, and they've also grown both their revenues and their earnings, while at the same time buying back 1/8 of their business. The company's free cash flows are down, however, due to some big changes in back-to-back years. Those are charges that you'd want to dig into and learn more about. Due to those, Northrop Grumman does not produce enough free cash flow to comfortably support their debt position. Also something you'd want to dig in and learn more about. Keep in mind this isn't financial advice. Right now, Northrop Grumman's free cash flow to enterprise value yields don't look attractive compared to the 10-year treasury. When we performed our discounted cash flow analysis, from today's valuations, if they're the same 20 years into the future, if you believe those assumptions and you want a 15% rate of return, an estimate of Northrop Grumman's fair value per share is around $143. The company last traded at those levels back in November of 2014. When we look at all the factors of our analysis, Northrop Grumman looks like a modest candidate for more research.